All right, let's talk about one of the biggest headaches for any investor, trying to time the market. What if there was a way to completely skip that stress? A simple strategy that actually uses market crashes to your advantage. Well, there is. Today, we're diving into dollar cost averaging. It's the ultimate autopilot approach to building wealth.
So, here's what we're going to cover. First, we'll tackle the market timing trap, why it's so stressful. Then, we'll get into the autopilot solution itself. After that, the really cool part, how downturns can, believe it or not, make you richer. We'll show you how to set it up, and then the grand finale. We'll look at your potential million-dollar future. Let's get right into it. Okay, section 1, the market timing trap. This is that feeling, the stress of trying to guess the perfect moment to jump in. So, are you tired of trying to invest at the perfect time? Does this sound familiar? You've got some cash ready to go, you know you should be investing, but you're just frozen, right? You're wondering, is now the right time? What if I buy and it crashes tomorrow? You are definitely not alone in feeling this way. And this is what causes that classic analysis paralysis. You're terrified of buying at a peak, right? So you wait for a crash, but that crash might not show up for years. And while you're waiting on the sidelines, the market just keeps ticking up. You turn on the financial news, one expert says buy, another says sell. It's overwhelming. So what happens? You end up doing nothing. The money just sits there. So how do you break out of that trap? Well, that brings us to our second section, the autopilot solution. Let's talk about something called dollar cost averaging, or as you'll often hear it, DCA. Okay, so what is dollar cost averaging? It's actually super simple. It's just the practice of investing a fixed amount of money at regular intervals, no matter what the market is doing. Think about it. Maybe it's $200 every single month on the dot. The market could be soaring. It could be tanking. Doesn't matter. Your investment goes in. The two magic ingredients are that fixed amount and those regular intervals. A great way to think about it is like your Netflix subscription, right? It just comes out of your account every month automatically. But instead of binge watching shows, you're binge buying your future wealth. It's a recurring payment that builds assets in the background without you even thinking about it. And here is where the magic really happens. This is the core of DCA. When the market is high and prices are up, your fixed amount, let's say that $200, it just buys you fewer shares. That's natural. But when the market is low, that same $200 suddenly buys you more shares. You see, you are automatically, without any effort, buying more when things are on sale. It's like you're programmed to buy low. Okay, and this simple idea leads to probably the most powerful part of the whole strategy. Let's get into how downturns can actually make you richer. Yeah, you heard that right. This is where the math gets really cool, and it might just blow your mind. All right, let's walk through this example right here. Say you're investing $300 a month. In month 1, the share price is $100. Simple enough, your $300 gets you 3 shares. But then, oh no, the market takes a hit in month 2. The price drops to $75. Now, most people would panic, but your automatic investment just goes through. And that same $300 now buys you 4 shares. See? Then the market starts to recover. And as the price goes up, you start buying fewer shares again. So what's the result after just 4 months? Well, you invested a total of $1,200. That's just 300 times 4. But look at this. Your portfolio is already worth over $1,400. That extra money, that's the payoff. That's the DCA magic right there, turning that dip into pure profit. And get this. This is the key takeaway. Your portfolio is up 20%. But the actual share price, it only went up 10% from where it started. You literally beat the stock's own performance just by being consistent and automatically buying more when it was cheap. That is the power of this strategy. So this completely flips the script on how you see the market. Market crashes suddenly become your biggest advantage. You stop dreading them because you know your system is programmed to buy shares on sale. Every dip is just a Black Friday sale for your portfolio. Okay, so you're probably thinking, this sounds great, but how do I actually do it? Let's get into the set it and forget it part. This is your 10-minute setup guide to getting this whole thing on autopilot. Honestly, it's just a few simple steps. First, you open a brokerage account. Second, you link your checking account to it. Third, you set up automatic transfers, so the money moves over every month without you lifting a finger. Fourth, you set up the automatic investment of that money. And then step 5. Well, this might be the most important one. You delete the app and forget about it. I'm serious, deleting the app is key. The whole point of this is to take emotion out of the equation.
The more you check your portfolio, especially when the market is down, the more tempted you'll be to panic and mess with the system. The real beauty here is that it works best when you just let it do its thing. And speaking of messing with it, here are the 3 big DCA killers you have to avoid. Number 1, stopping during a downturn. That's literally when you get the biggest bang for your buck, so don't do it. Number 2, trying to improve it by timing your buys. Just let the system work. And number 3, forgetting to increase your contributions when you get a raise. You want to make sure your investing power grows along with your income. All right, let's zoom out. We've talked about the why and the how. Now for the really exciting part. Let's look at your $1 million future. This is the 30-year reality check of what this simple habit can actually do. So let's take a hypothetical person. They're 25 years old and they start investing just $400 a month. For a lot of folks, that's less than a car payment. They just set it on autopilot and let it ride. Okay, so what happens? By the time they hit age 65, assuming a pretty standard 8% average return, that portfolio could be worth almost $1.4 million. Let that sink in. That's the absolutely staggering power of just being consistent and letting compound growth do the heavy lifting for you. And check out this breakdown, because this is where it gets really mind-blowing. Over those 40 years, the total amount of money you actually invested out of your own pocket is about $192,000. But the final value is nearly $1.4 million. That means over $1.2 million of that is just growth. That's your money working for you, making more money. That is how you build real wealth. So I want to leave you with some homework. This isn't just a cool theory, right? It's a real plan. So ask yourself, what small, consistent amount can you start investing this week? It doesn't have to be a huge number, just something you can put on autopilot to start building your future. Because honestly, starting small is 1,000,000 times better than not starting at all.